Good morning, good afternoon, good evening, wherever you're joining us from, for our latest webinar on accounting for climate in financial reporting. My name is Sandeep Jadeja. I'm a technical manager at the Climate Disclosure Standards Board. For those of you who aren't familiar with us, the CDSB was set up in 2007 at the World Economic Forum to advance the integration of climate and environmental information into mainstream annual corporate reports by companies to provide information to investors on such matters alongside financial information in order to aid in their capital allocation decisions, ultimately one of the pieces in the puzzle to transition to a low carbon future. Today, we've launched a second supplementary paper to the guidance that we published last December, supporting preparers in integrating climate into their financial reporting. This paper, like the first supplementary paper that we launched back in October, takes a deeper dive into how climate might need to be incorporated into accounting and financial reporting, where considered material, in relation to a number of specific IFRS accounting standards. I'm delighted that we have colleagues from KPMG UK who have joining us today, who have led in the development of the supplementary papers, who will be providing highlights from the latest paper. So I'd like to welcome Helena Watson, Director of Accounting Advisory Services, Nisha Sanchan, Senior Manager, Accounting Advisory Services, and Bilan Leirifai, Manager, Accounting Advisory Services. Before we get to that, I would like to welcome also Anne Tarca, Board Member of the International Accounting Standards Board, IASB. The IASB and the IFRS Foundation have really driven the conversation in reflecting climate-related matters into financial reporting. So I'd like to pass over to Anne and ask the question, if I were a preparer producing financial statements today under IFRS standards, why do I need to think about climate change?
Thank you, Sandeep. And thanks for inviting me to join this panel. I'm very pleased to be here. So to answer that question, as a preparer of financial statements, yes, you need to think about the accounting standards. So we have two publications, and I'd like to speak to you briefly about both of those and some other publications that are also relevant. But bottom line is, we have these two publications. They provide guidance for preparers about the financial statements to look at to make decisions about how climate-related matters need to be factored in to measurement, disclosure, presentation, and recognition as you're preparing your IFRS financial statements. So firstly, I'll speak about the education material issued by the IASB in November 2020. It's available on our website in the supporting implementation section. Now, this document makes reference to specific IFRS standards and indeed specific paragraphs within those standards. The aim of this document is to give clear direction for financial statement preparers for the matters that they should be considering. There are 11 standards, and this is just examples. That's not the finite universe of standards, but there are 11 standards here in this document as examples of where to look. So, for example, IAS 1. If an entity expects material adjustments to carrying amounts of assets and liabilities within the next financial year because of climate-related risks, by applying IAS 1, entity needs to make disclosures about its assumptions about the future and the nature and carrying amount of assets and liabilities. So we see this as a requirement for disclosure in financial statements. Similarly, we can look at IAS 16 on asset measurement, 36 on impairment calculations, 37 on measurement of provisions. IFRS 7 also requires disclosure in relation to financial instruments. They are all relevant standards that preparers need to look at. Climate-related risks are not specifically mentioned, but where entities know that there's a material impact on the judgments and estimates they're making, these judgments and estimates need to be disclosed. There's a call for climate-related risk matters to be reflected in recognition and measurement, in presentation, in disclosure from investors. And this is a very strong call. This call is actually backed up by regulators ESMA has recently stated that climate-related matters will be an enforcement priority for them as they look at financial statements of 2021. So let's take an example where a company is factoring climate-related risks into the preparation of financial statements. Let's look at Woodside, which is an Australian-listed oil and gas company. In the financial statements of 2020, Woodside recorded an impairment expense of 5.2 million on oil and gas assets and exploration and evaluation assets. This was based on a reduction in oil and gas price assumptions, in increased longer-term demand reflecting uncertainty, and other factors, including increased risk of higher carbon pricing. So an analysis of climate risk impact and carbon pricing was specifically mentioned in the impairment recoverable amount assumptions. It was also notable that this company mentioned climate-related impact in the chairman's report as an issue important to investors. In fact, for this entity, number one issue important to investors. And it was also mentioned in the key audit matters noted by the auditors. Next slide, please. Second item I want to mention was an in-brief article prepared by board member Nick Anderson and made available in November 2019. Now, in this article, Nick points out that standards don't mention explicitly climate-related and other emerging risks, but standards do address issues that relate to these risks. So this article sets out the disclosures are required by the standards when information is material. So when we talk about materiality, we're talking about the fact that this information affects the judgments made by users of the information. So these users, well, we're referring here, included in users, we refer to investors. They tell us they want to see climate-related risk disclosures, not just in the front half of the annual report, excuse me, but they wish to see these risks factored into recognition and measurement and explained in the disclosures. They want to see consistency between what's in the front half of the annual report and what's in the audited financial statements. So materiality is a key issue here. What does the IASB have on this topic? So we have a materiality practice statement, and this gives guidance to preparers when they're making their materiality judgment. So this practice statement reminds us that the need for materiality judgments is pervasive in the preparation of financial statements, and these materiality judgments apply to recognition and measurement, presentation, and disclosure. In the materiality practice statement, there's an example C, and that's relevant on this topic. It illustrates that climate-related matters would form part of an entity's impairment disclosures. The practice statement also reminds us that materiality is about not just the amount, but also the nature. And example K illustrates this and reminds us that a disclosure of a lack of exposure can be material information. The final publication from the IASB that I want to mention is the management commentary practice statement, the exposure draft, which was released in 2021. The management commentary practice statement builds on it provides a framework for preparing the narrative report, which is the management commentary, and it builds on various innovations that have been occurring in narrative reporting. But it is designed so that a company can produce a single report, and in that single report, there'll be information for investors and creditors, that the information they need for assessing companies' prospects. There'll also be information about a company's intangible resources and relationships, and crucially, information about sustainability matters that affect the company. So the key thing here is that management commentary would not only explain financial performance and position as reported in the financial statements, but it would also give insights into factors that affect the company's ability to create value and generate cash flows, including in the long term. So the management commentary practice statement highlights the interconnected nature of financial information and sustainability information. And for us, the bottom line is that the requirements in IFRS standards, as they're outlined in the documents that I've mentioned, mean that investors can rightly expect to see climate-related risk, when it's material, to be factored into recognition, measurement, presentation, and disclosure within the audited financial statements. So I'll stop there. Thank you.
Wonderful. Thank you very much, Anne. So one of the key takeaways in the headline deck I'm taking away from what you've discussed is, if financial statements are being prepared under IFRS, climate is one of those matters that need to be considered, and where material needs to be reflected in financial reporting. And I just want to flag two key things here. Investors have been really, really vocal about this, and they've made clear that they consider climate-related risks and opportunities to be material, and so needs to be reflected appropriately in financial reporting. So even if it doesn't meet the necessarily size aspect of materiality, that does still hit the nature aspect of materiality. And then to lead us on to the next point, companies still aren't doing enough based on the latest research that's coming out. So Carbon Tracker put out a report a couple of months back, and the headline finding there was there's a long way to go from a reporting aspect and reflecting climate in financial reporting. So with that, I'm now going to pass over to our experts from KPMG to provide a deeper dive in some of the key considerations that we've covered in our latest supplementary paper. So over to you, Helena.
Thank you, Sundip. Yeah, and it's great to be here today talking about such an important topic of climate in financial statements. Just before we kick off, I'll introduce my team. So I'm Helena Watson, and I'm joined by two of my colleagues, Bolanle Rufai and Manisha Sanchin. And we're all from KPMG's Accounting Advisory Services team. So we provide advice on a whole range of different financial and corporate reporting matters. And the people you've got with you today are really focusing on implications of climate in the annual report. So Sundip said, we're here to run through a few of the topics that we included in the paper that was released today. And these are topics that are all not included in the papers that Anne was talking about earlier. These are other standards. And what we're trying to do with this paper is just bring to life and illustrate some ways that climate could, in some instances, have an impact on accounting under standards not covered by the original IASB papers that Anne discussed. So we're going to kick off with Bolanle talking about considerations for lease accounting under IFRS 16. We're then going to move on to the topic of employee benefits. Manisha is going to start covering share-based payments under IFRS 2, and then I'm going to talk about employee benefits under IAS 19. And then finally, I'm going to finish off with just a few reflections on revenue accounting under IFRS 15. For some of you, we also, in the paper, we also covered some sector-specific standards. So that was looking at IAS 41 and agriculture, and IFRS 6, so relevant for extractive industries. If those standards are relevant to you, please do take a look at the paper, because we've got content in there. We just didn't have time to cover everything on the webinar today. So with that, I'm going to hand over now to Bolanle to get us started with leasing.
Thanks, Helena. So good morning, everyone, or good afternoon, or good evening, like Sundip said earlier on. So once again, my name is Bolanle, and as Helena already introduced, I am going to be talking about IFRS 16, which is probably the most interesting of all the other standards. Helena is going to disagree with that, I'm sure. So I am going to be talking about IFRS 16, particularly how climate or climate-related factors may impact lease accounting. Now, talking about impact, I think, the application of IFRS 16 itself can be quite judgmental. It often involves entities making some important assumptions and estimates, for example, about whether a contract contains a lease or is a lease, judgment around the lease term or lease payment, and sometimes even the discount rate to be applied to those lease payments. And so all of these important estimates and judgments and assumptions could be impacted by climate-related factors. And then again, because it is common, for companies to lease assets for use in their businesses over long periods of time, It then means that the scope of impact from climate-related factors on lease accounting is potentially high. Affecting not just companies that lease those assets, but lessors, could also be impacted. So in one sentence, what have I just said? I have said climate risks and opportunities can affect the judgments and estimates and even assumptions that we use for our lease accounting, particularly for long-term leases. So in the order that I have on the screen, I am going to touch on the potential implications for lessor accounting very quickly, and then move on to talk about some common implications for lessees. My intention is then to finish off by touching on some considerations on applying the lease definition under IFRS 16 to some new climate-related contracts that we are beginning to see in practice. So starting with lessors, particularly in the context of polluting assets, I would say, lessors could face a variety of climate-related issues, and this could have significant financial statement impact. Whether those issues arise from physical risks like the risk of flooding or fire, or the risk from transition like government action, changes in consumer behavior, or changes in demand. Like I said, all of these issues could have significant financial statement impact such as impairment of lease receivables that lessors recognize, or the impairment of the underlying fixed assets. Other impacts could also relate to lessors needing to reassess their useful lives, the useful lives of their assets, or useful lives or the residual value of the assets, which could then, consequently mean accelerated depreciation in the financial statements. So basically, for lessors, the accounting issues that I would normally expect to see are not covered under IFRS 16. They are mostly covered, by IAS 16 or IFRS 9, which are topics that are not on the agenda for today. So I'm going to be focusing on IFRS 16. So that's that on lessors. I am now going to be focusing on lessee accounting now. So the potential accounting considerations for lessees you could have, instances where certain leased assets might become either obsolete or unviable, or sometimes critically important in the near future. But what we see in practice is that the more common accounting implications would often depend on the related lease agreement or the associated lease agreements, whether those have renewal options or termination options. So you as a lessee, you have, that there is a potential for assets being quite unviable or obsolete or very, very important, depending on the strategy. And then I have said, it would be good for lessees to, as a starting point, have a look on the lease agreements and see whether they contain renewal or termination options. So what does this really mean in practice? If I start with an example of a long-term lease of a building, let's assume that this contract does not have any renewal or termination options in the contract. If the business identifies that the asset or the building will no longer be required for their net zero transition plan, so what are the possibilities? What are the options? Probably top on that agenda would be that they seek to renegotiate the lease. And the opposite could also happen. You could have a building that is potentially very important for an entity to achieve its net zero transition plan. They could also renegotiate to have some extension options built into that contract. I should say that under IFRS 16, changes that result from renegotiating your lease contract are lease modifications. So in practice, we see that accounting for lease modifications can be quite complex. The accounting will depend on on whether, as a lessee, your lease modification, whether it meets the criteria to be treated as a separate lease under IFRS 16 or not. So if it is a separate lease, you apply IFRS 16 as you would for a new kind of lease. And if it is not, then you would probably have to remeasure your lease liability, adjust right of use assets, and in some cases, you would have to recognize gain or loss in the profit or loss account. So that's one side where you have lease contracts containing renewal options or termination options. On the other hand, where lease contracts do contain renewal options or termination options, climate risk or uncertainties may change the economic incentives, the incentives that influence a lessee's decision on whether to use an asset or cease using the asset in the near future. Now, such significant changes could trigger a reassessment of the lease term, and that could consequently lead to remeasurement of lease assets and lease liabilities. And when that happens, what IFRS requires is that you determine a revised discount rate that would then be used to remeasure your lease liability. So, two key points that I have just explained as potential implications for lessees. The first one, which is lessees having a situation where climate or climate-related factors can lead to lease modifications and how they would potentially account for that. I have also said climate risk or climate opportunities may lead to the reassessment of initial judgments around lease term, whether that's termination options or reassessing renewal options. So finally, the other point I wanted to quickly touch on is the potential complexities and the accounting issues that could arise in climate-related arrangements. Arrangements, for example, contracts relating to renewable energy generation, for example, the use of solar farms and wind farms. They're becoming, quite popular these days to generate green electricity. So simply put, I guess what I'm trying to say is that climate change or climate risk or climate opportunities could be a catalyst for companies for entering into new contracts or new arrangements. We have seen some examples in practice, and these are becoming increasingly popular. However, like I said when I was explaining lease modifications, additional complexities may also arise when assessing whether such new climate-related agreements, whether they contain a lease or not. For example, again, I have so many examples, but I would use one that I have come across recently, an arrangement between a customer and a wind farm operator where it's agreed that the customer will take all of the electricity produced by the wind farm, but that will be delivered via a grid. Does that arrangement contain a lease? What I would say is that from experience, it's usually a matter of assessing all the facts and circumstances. And I know for one that it is more than meets the eye. But what I want to drop on this point is that it is important for us to remember that under IFRS 16, an arrangement will contain a lease when all the three criteria are met. That is, there is an identified asset, the lessee obtains substantially all of the economic benefits from that asset and has the right to also direct the use of the asset. So in conclusion, I am just going to reiterate that IFRS 16 requires companies, lessees, to provide clear and meaningful disclosures about their leasing activities and the significant judgments that they have made in determining whether those arrangements contain a lease or not. It may also be important to consider how climate factors have had a material impact on those judgments and your lease accounting. So that's all I wanted to talk about on IFRS 16. I hope that you have found this session useful. We have included some examples in the supplementary paper, which will be released, I think, after this webinar. So hopefully it helps to bring these potential issues to life. I will now hand over to Manisha, who would talk about share-based payments. Thank you.
Thank you, Bolanli. Hi, everyone. So yes, as Bolanli mentioned, I'm going to talk to you about how climate-related factors can impact the accounting and reporting of share-based payment arrangements with employees. So I'm going to focus on 4 areas today. First one, share-based payment arrangements that have a climate-related condition. Those that do not have such a climate-related condition. And I'll talk a little bit about potential complexities that may arise when valuing share-based payment arrangements. And finally, I'll cover how climate can impact the disclosures of share-based payment arrangements. So let's start with share-based payment arrangements that have a climate-related condition. So by climate-related condition, I mean a climate metric target. So just to give you an example, one would be a greenhouse gas emission reduction target. So what we are saying is that a number of companies are including a climate-related condition in their share-based payment arrangement with their employees. And this is effectively to align the employees' performance with the company's climate strategy. So climate-related condition in share-based payment arrangements can be a performance vesting condition or a non-vesting condition. And in practice, we're actually seeing this being more a performance vesting condition. How the climate-related condition is treated drives the accounting. So let's look at this in a bit more detail. So where the climate-related condition is a performance vesting condition, it is generally a non-market condition. So what does that mean in terms of the accounting? So in that case, the climate-related condition will not be considered when determining the fair value of a share-based payment arrangement. But instead, it would be taken into account when estimating the number of awards that are expected to vest and the share-based payment charge to record. On the other hand, if the climate-related condition is a non-vesting condition, it will be taken into account when determining the fair value of the share-based payment arrangement. So when is a climate-related condition a performance vesting condition, and when is it a non-vesting condition? So let's use an example to illustrate these 2 possible treatments. So let's say I have a company that has introduced a new long-term incentive plan for its employees. And one of the conditions for the employees to get the company shares is that a greenhouse emission reduction target must be met in 3 years. And also the employees must remain in employment for the next 3 years. So in this example, as the emission reduction target period is the same as the service period of 3 years, the emission reduction target will be treated as a performance vesting condition. If the emission reduction target period was, let's say, 5 years and the service period was 3 years, that is here the climate-related condition extends beyond the service period, the climate-related condition will be treated as a non-vesting condition. So now let's look at share-based payment arrangements with no climate-related condition. So for share-based payment arrangements that do not have a climate-related condition, climate-related factors may still impact the measurement of such arrangements. This will be the case where those climate factors can influence the conditions of a share-based payment arrangement. For example, where climate factors can impact whether profit targets are met. Moving on to fair value of share-based payment arrangements. So climate-related factors may make valuation of share-based payment arrangement more challenging. It may be more difficult to determine inputs to the valuation of share-based payment arrangements relating to unlisted shares. For example, it may be more difficult to estimate the share price and related volatility. So now that we've considered how climate factors can impact the measurement of share-based payment arrangement, let's briefly look at what companies need to think about when considering disclosures. So as you're aware, IFRS 2 has numerous disclosure requirements, so I'll pick on a few of these. So using my earlier example, where the company had introduced a new LTIP which contained an emission reduction target, the company will describe and explain its new long-term incentive plan and provide details of that emission reduction target. And if material, the company would also disclose the number of awards that have been granted that are subject to that emission reduction target and the maximum terms of these awards. The disclosures would also discuss how the fair value has been determined and how the climate-related conditions were considered, if at all. So these are the points that I wanted to share with you today. I hope you found this presentation helpful. Thank you for listening. I'll now hand over to Helena. Thank you.
Thank you, Manisha. Yeah, so IFRS 2, definitely a standard of relevance to a lot of different entities. I'm going to keep on that sort of employee benefits theme, but we're going to move on to IAS 19 now. So, and I'm just going to reflect on a few of the different types of benefits that are covered by that standard. I'm going to start with long-term benefits, then think about shorter term arrangements, and also just reflect briefly on termination payments. So starting off with long-term benefits then, when we're thinking about implications of climate on accounting, we commonly expect that the more significant impacts are likely to be on accounting that is influenced by your longer term assumptions and estimates. So on the topic of employee benefits, the first thing certainly for me that comes to mind is accounting for some of the longest term arrangements like defined benefit pension schemes. Taking that as an example then, if we've got a defined benefit scheme under IAS 19, we have our plan assets that are held at fair value, and then we also use an actuarial valuation method for the defined benefit obligation. Now, the valuation of those plan assets, that's accounted for under IFRS 13, and we're not trying to cover that too much today. But what I did want to reflect on is that under IAS 19, we do need to think about the disclosure requirements when we're thinking about these plan assets. If you ask yourself the question, do you think you give enough information about the types of plan assets so that people can understand how they might be exposed to climate risk? Particularly some of the required disclosures around stuff like concentration of risk might be becoming increasingly material, particularly when different assets are exposed in different ways. On the liability side, then it might be increasingly important for management to understand how actuaries have included climate factors in the demographic and the financial assumptions that really drive that accounting. If I move on to think about another type of employee benefits though, short-term benefits, it's possible that these might be impacted particularly by some of the climate commitments and the policies that the business is putting in place. As companies are trying to reduce their carbon footprint, we are seeing various new types of benefits offered. Things like maybe a company car scheme with incentives to have electric cars. These short-term benefits, they're generally accounted for just using normal accruals accounting. Third type of employee benefits then that you could see impacts for would be termination payments. And what I mean by that is payments made in exchange for the termination of employment. So things like redundancy payments. Now, if you have a formal restructuring plan, that's something that's accounted for under IAS 37. And then there are really key judgments there about whether and when a provision is recorded. But payments for things like voluntary redundancy are going to be covered by IAS 19. And in some cases, there may be a real judgment to make about whether payments are post-employment benefits, which are very much accounted for, just accrued over the service period, or if it meets the definition of this termination period payment, rather, which is then reflected as both a liability and an expense when you would record that restructuring provision. I think there's lots more I could say about IAS 19 accounting, but hopefully that just gives you a flavour of a few things that you might need to be thinking about. And I'm going to move on to talk about accounting for climate under IFRS 15, so our revenue standard. The areas I particularly wanted to reflect on here were multi-period contracts. So this is the long-term arrangements where you have judgments and estimates that you're making today, but that could actually impact your revenue recognition throughout the duration of the contract. And also thinking about impacts on accounting for things like contract costs and onerous contracts. So the type of contract that I think, from my perspective, we may be most likely to see impacts on is these multi-period contracts, because they're long-term arrangements. Particular industries that this might be relevant for, things like construction or aerospace and defence or business services, where you can have particularly long-term contracts and they can often be very complex. And what I wanted to do today was just pick out a couple of areas where climate risks could impact that revenue accounting today. So I want to talk a bit about variable revenue estimates and also over time revenue recognition. So starting with variable revenue then, let's just take an example. Let's take an example of a long-term service contract where we might have something like penalty clauses for failing to meet agreed sort of KPIs or performance indicators. Now, IFRS 15, if we start with the theory, under IFRS 15, we're required to estimate variable revenue up front, and then we need to reassess that at each period end. Now, if we have something like penalties, and under IFRS 15 rather, they're generally treated as a reduction in revenue and a type of variable revenue. So we need to make a judgment about whether we expect that something like penalties might be anticipated. And in fact, the way IFRS 15 works is that we may need to constrain the total transaction price that we calculate in order to make sure that we only include revenue that is highly probable not to reverse. Well, thinking about my example, we've got these penalties. Well, if climate causes one thing, it's going to be uncertainty. And in this example, there might be additional uncertainty around whether those penalties are incurred. Might make judgment much more challenging about what to include in our total transaction price, and certainly might lead to something like additional disclosure if this is material for the contract. Another impact in longer arrangements that are counted over time under IFRS 15 will be how climate factors might impact the total costs to complete the contract. So again, let's take an example. Perhaps let's choose maintenance this time. If we've got a contract which is long-term and is deemed to meet the overtime criteria. Now, you might be using a measure of progress for that contract, such as one based on the percentage of total costs expected that you've incurred to date. And this is where something like climate-related uncertainty can really rear its head again. Are you comfortable that you've included all of the potential costs that are caused by climate factors into that estimate of total costs to complete the contract, as well as, of course, the total estimate of revenue? If you've got changes in those cost estimates or that revenue, that will change your percentage completion and therefore the revenue recognized to date. And now these contracts are often extremely complex and highly judgmental. So having a clear understanding and if it's material, making disclosures around this is something that these types of industries may want to consider. Now, IFRS 15, it's a revenue standard, but I've been talking about costs already, and certain costs are actually directly treated under IFRS 15 as well, either as a cost to obtain the contract or cost to fulfill a contract. Now, in some places, these can be quite material, and in particular, they are actually also allowed to relate to anticipated future contracts, as well as existing arrangements. Now, again, where we have uncertainty about future demand for products and services, or just uncertainty around future profitability, it may become a little bit more challenging to justify recognizing such costs as an asset. Before I finish then, I just wanted to reflect on one last area of potential impact on revenue contracts, and that's where climate might be driving more contracts to become onerous. Now, the treatment of onerous contracts is covered by IAS 37, our provision standard, and we recognise a provision if the unavoidable costs of meeting the contract exceed the economic benefits. So thinking that in terms of the context of a revenue contract, it could be because the total estimate of revenue you make is lower than the total anticipated costs you have to deliver that contract. I've already discussed examples of how judgments around variable revenue can reduce that transaction price or the total revenue estimate. Going back to our maintenance contract as well, I've already talked about how if your costs to deliver the contract go up, then again, these are types of things that may be making it more likely that contracts become onerous and that we would need to recognise a provision. So I hope that is a useful reflection on some of the potential climate impacts under IFRS 15. Ultimately, there's so much variety here. It's going to be a company-specific thing that you need to look at, but hopefully those are just bringing to life a couple of examples. So with that, I'm going to hand back to Sundip.
Brilliant. Thank you very much, Helena, and thank you also, Manisha and Bologna. I think that's been really, really helpful to try and bring to life some of the content that is covered in the paper, and there is a lot of good stuff in there. And just to clarify, the supplementary paper has been launched. The second one has been launched today. It's available right now, and I believe the participants on the call have already received emails with links, so you should be able to take a look at that when you please. I'd also just flag as well, please do take a look at our previous papers, which cover standards that were flagged as being particularly relevant from a climate perspective by the IASB and IFRS Foundation, that Anne's already mentioned from the respect papers in 2019 and 2020. And there's a lot of great content in those papers, both kind of a discussion on the context and theory around climate and accounting and the disclosure implications in relation to those standards, but also some really fantastic illustrative examples to bring the theory to life and trying to highlight how this might work in practice. So I'm going to move over to some questions and answers, and we've received some questions already, but please do shoot those through via the Zoom platform if you do have any questions for our speakers. So to begin, and a question for Anne. So, and this is a big one, and one that's already kind of been quite an interest from our audience, but what does the creation of the International Sustainability Standards Board by the IFRS Foundation mean for integrating climate into financial reporting? And just to add on to that, how do you see the management commentary practice statement working given the establishment of the ISSB?
Thanks, Sundip. So we're all excited about the establishment of the sister board, the ISSB, and stakeholders have particularly said they want to see the IASB and the ISSB working together. They want the standards, the financial reporting standards, IFRS, and they want the sustainability standards to work together to have a seamless existence. So we've had a lot of that feedback through consultations and through the agenda consultation. But not only that, the trustees themselves has said that the boards need to work together. They need to collaborate. Now, so we're already starting to think about how that might work, and more information will become available, and we'll be able to communicate more to all the interested people once we do have the ISSB up and running. And so that's hopefully middle of 2022 up and running, but obviously a lot of behind the scenes work is going on. And as part of that behind the scenes work, it does make the IASB think about areas of collaboration and areas where we need to be thinking how we will be doing that work. So through agenda consultation, there was a lot of points raised to us about things we should consider and things that may consider for specifically relating to issues that are people might consider climate related, for example, or more environmental. So in our agenda consultation, there's a couple of specific things where people have suggested changes to the accounting standards themselves that would facilitate and encourage more disclosure. So Sandip, in his introductory comments, talked about the investor demand for more information and how for some entities that's not being provided. So should the IASB make some changes to the financial reporting standards to facilitate the provision of that information? So that's something the IASB can think about, and that's within the context of financial reporting standards. The other part of the question relates to things that are under the, in the domain of the ISSB, and the management commentary practice statement is an obvious candidate. So perhaps the way forward on that one will be for the two boards to work together on it, for it to be a collaborative project. It would seem to be a key candidate because there's just so much within narrative reporting within that management commentary framework that is relevant to providing the information the investors want on we can use the term sustainability more broadly, or we can start talking about climate related risks specifically. So that would seem to be one for us to work together on, but obviously we're waiting to hear, to talk to our colleagues who will make up the board and staff of the ISSB. Thank you, Sundip.
Brilliant. Thank you very much, Anne. That's really, really helpful. Helena, one for you then. What tips do you have for preparers? We've already kind of, we've set out these 3 papers. There's a lot of great content in there. So the onus now on preparers to get moving with this. So what tips do you have for preparers starting out in reflecting climate-related factors in their reporting, and all those who are seeking to improve on what they've already done previously? Because we've already seen examples of companies starting to put something down into financial reports, but how can they level up?
Yep. No, it's a great question. It's one we get all the time. How on earth do I start with this? So I think for me, the very first step has to be to make sure you've got a good understanding of what types of material climate related risks and opportunities your business is exposed to. Without that understanding, it's so hard to see where to start. But if you can get that understanding of what types of risks and opportunities we're talking about, an indication of which areas of the business that might be exposed to those, and also really importantly some idea of timescales of potential impacts, you can start to narrow down where to focus. And for me, that narrowing down is important, because otherwise this can feel so daunting, and we've got to prioritize the most material impacts first. So thinking about how to do that, there's all sorts of examples, but understanding if you are expecting that climate risks are going to hit you in the medium to longer term, one thing I always encourage people to do is, well, think about which assets that you have on the balance sheet today are impacted by the medium to longer term. If you've got an asset with a useful life or that's fully recovered in a very short period of time, then the likelihood of that being impacted by climate risks that impact over the longer term is much lower. I think I'll be brief, but another couple of tips I would say is we're seeing so many different commitments being brought out at the moment. And so one really good place to start is just make sure you've got a good list of what are all those commitments that you've made, and make sure that the finance team have been down that list and understand what's the implication of those commitments you're making on the financial statements today. So, if you've committed to major investment programs or net zero, what does that mean for the assets you've actually got on the balance sheet today? Does it reduce the useful life? Is it that perhaps you're bringing forward some decommissioning provisions and you've got to think about the impact of discounting on those? So just understand what the commitments are, and then you can see where there might be implications. And then I think the other thing I'll just very, very quickly before I finish is you've got to understand the impact on sort of judgments and estimates. For so many businesses, understanding the real detail of quantitatively how climate might impact you, people are really struggling with that. It's very, very hard to do. But what you can do is provide more transparency by identifying where the assumptions are that might be impacted, and just giving information about how that links to climate risks and where there might be exposure. That is something you can do now, even if you can't fully quantify something. And so, yeah, it's just that disclosure is really important. I'll stop at that.
Brilliant, and that's really helpful. I think transparency is really name the game here. And the second point you made is one we've been thinking about a lot. TCFD has driven kind of narrative disclosure of climate-related risks massively in recent years. But there is that issue about disconnection between what's being said in the front half and the back half. So just having a look and understanding what type of commitments or what type of disclosures you provide in the front half, and ensuring you're at least being consistent with those is a fantastic starting point. Manisha, one for you. So you referred to greenhouse gas emissions reduction conditions in your presentation as one of the conditions you're seeing. But are there any other kind of climate-related conditions that companies are typically including in their share-based payment arrangements?
Thank you, Sandeep. So yes, so there's no clear trend out there. Some of them, as you said, are including greenhouse gas emission reduction target as one of the conditions, but this would vary across industries and also across companies. And companies are including these climate-related conditions in their share-based payment arrangement to align the employees' performance with their own goals. So we would expect those to be consistent with the company's goals, or a combination of those. Thank you.
Brilliant. Thank you very much. And I'm working with my phone, so I can't actually see hands going up and down, but I believe you had you want to add on to Helena's the question from before.
Thanks, Sandeep. Yeah, I did want to just add to Helena's point that as companies think about the disclosures, it now becomes so important to even say things like there is no material, we do not consider there's a material risk here. Whereas in the past, people might not have felt they have to make that kind of statement. But now, let's say they're operating in an industry where other people are making disclosures about climate-related risks because they're material for that entity, and they're in the same industry. Investors be really interested to know that the judgments and estimates that Helen is referring to in this entity's situation come to the conclusion that there isn't a material risk. So that type of disclosure is also important.
Yeah, and I believe there's something in the material impact statement that exemplifies that. And just having that information that actually companies that has not been material is really important information for investors to then make their own decisions. So no, that's a really, really important point. Another one to you, Anne, and it touches on something you've already kind of flagged. The papers that have been produced by the IASB and the IFRS Foundation covered, and I believe they covered climate-related risks and other emerging matters. With the creation of the ISSB, which will be covering reporting on more than just climate, should preparers also be thinking about reflecting wider sustainability matters in their financial reporting?
I think that already companies are making reference. They're doing a lot of disclosures. But you mentioned the carbon tracker report that found in their study of the financial reporting, there's a lot of disclosure up the front and there's not so much disclosure at the back. So there's an inconsistency happening there where companies are recognizing the importance to investors and more broadly, the importance of these issues. And they're saying things about them, but they haven't reached the point of bringing them in to their financial statements. So a presentation like today and the work that CDSB is doing with KPMG, these reports can really facilitate people in that process of thinking about it and getting it in there. So when you ask me about, where I see wider sustainability reporting working in financial statements, it's going to be really the judgment of the entity, isn't it, into what's material. And it isn't surprising that the oil majors have picked up, and they are the leaders in terms of making the disclosures both in the front end and the back end. And that is as it should be, because we all must expect now that there are bringing forward into asset retirements, there are exploration and evaluation assets that are not going to realise their potential and so forth. But this whole issue of the wider sustainability is such an interesting one, and I know CDSB has been working on those preliminary documents with IFRS Foundation, with other parties, with people from Sustainability Standards Board and Integrated Reporting, the Value Reporting Foundation. And I think the approach being taken off the building blocks is a really sound one, because the building blocks can allow people to build on to the standards that will come from the IASB. So the base standards are really focused on value creation. But if you're a jurisdiction or a regulator that wants wider corporate reporting of more sustainability related issues, that'll be able to be built on the base standards of the ISSB. So we're dealing in an environment where so many people have got different ideas about what needs to be reported and where it should be reported. I think today our focus is on what needs to be considered in the financial statements. And we've got some common ground on that. And then the next step is what's going to go in the narrative. But to your point you've already made, the coherence between the narrative and the financials is really important to the investors. And then there are those who are concerned about wider reporting, wider issues. And what the IASB will be doing, we believe, is a building blocks framework. So being able to develop standards that can be built on, so that as regulators decide that there has to be wider corporate reporting to meet a broader group of stakeholders, that can be accommodated by building on our focus at the IFRS Foundation, which involves CDSB, of course, our focus of getting out these ISSB standards.
Brilliant. Thank you very much, Anne. A quickly technical question then for I believe Blanley then. Does exposure to climate risk mean that companies must reassess their assumptions around lease terms every year?
Oh, thanks, Sandeep. I thought I wasn't going to get any question. But yeah, that's a really good question. And whoever asked that, thank you. I think the executive summary to that question is no. IFRS 16 does not require you to do a reassessment of your lease term every year. And what it says, or what IFRS 16 requires, is where you have a significant change in events or circumstances, which when you were initially determining your lease term, you did not consider. And those changes are within the control of the lessee or the company. Then you may reassess your lease term, whether it is reasonably certain you would take a termination option or an extension option. So, for example, if an entity has set, targets or ambitions for itself and has a transition plan. So it's something more than a commitment. This is not just a commitment. There is a net zero transition plan. And information from that plan, provides, you could say it provides significant change in circumstances. Then, you would expect a reassessment of lease term. Yeah, I don't know if that answers the question or if anybody wants to add to that.
Yeah, thank you, Belani. Helena, one for you then. What role does the audit profession have in all of this, and what is the profession, broadly speaking, doing to support clients in reflecting climate-related matters into financial reporting?
I think it's a really important question. First off, personally, I'm not an auditor, so I'm going to speak for myself, not for sort of KPMG or the profession more broadly. But I guess in my understanding, yes, clearly the audit profession does have a role to play in helping tackle climate change. It's something that's so front of mind for everyone. But if I think about my understanding, what's the role of an auditor? It is to challenge the recognition and measurement that climate might have on financial statements, and challenge narrative where, if you've got anything misleading or inconsistent between the narrative or in the strategic report or our MD&A, our front end, and the financial statements. And that is the role of an auditor. That's part of mainstream audit. And I think just to finish, auditors need to be independent though from the audited entities that they are looking at, and provide that independent challenge. So something I work with non-audit clients, I'm asking them, are you comfortable that within management that they've actually got the right processes, the right controls, the right knowledge to identify and respond to these climate related risks and to report on them appropriately. And in some cases, businesses are struggling and they don't have that, and in that case they do need some sort of third party support.
Brilliant, thank you. And we've got a few minutes left. Just a quick one at the end. Then it's a larger question. But how does the preparer go about deciding what should be covered in narrative reporting? And as we already discussed, that's part of the management commentary. And then what should be covered in the financial statements and company notes? Because there's already kind of discussion around including more on assumptions, etc., within the company notes. But could that also then not be included in the front half? So just as the IASB is being formalised, what do I do in the meantime if I'm a preparer?
Yeah, well, in the meantime, as a preparer, you look into the accounting standards, into your recognition, measurement, disclosure and presentation, and decide about what is material information that needs to be disclosed. Some of that will go within the financial statements. For example, we've been talking about the impairment note, we've been talking about provisions. So some of that information will go into the audited financial statements, into the notes. But in addition, companies regularly need to explain things in the report that accompanies the financial statements, management commentary, or whatever it's called. They regularly need to elaborate on what's in the financial statements, particularly with a forward-looking element to it, because that's what the investors are looking for. And if we think about investor presentations where people highlight things, they may use financial information to illustrate something and then elaborate further, because there is so much data that investors use that complements the financial information. So I think preparers, companies are already very skilled at working out where to put the pieces. I think our encouragement is that there needs to be more consideration of information that's material into the financial statements into the calculations, into recognition, measurement, presentation, and disclosure, more there. So if people are thinking about this issue, that's the bit to think about. And Helena's made suggestions of how to even begin that process. That needs to happen, because if anything, their companies are already in the process of a narrative up the front, a narrative about, oh, this is important. It's building up the actual putting it into the numbers and working out the impact when material in the numbers. And then that flows through and it will make the discussion up the front, be that in a management commentary or be that in investor presentations, that will make that so much better, because the investors will have more information to work with and then have confidence that it's being factored into the numbers. I think the frustration with investors at the moment, as I've heard about it, is the frustration that there is the talk up the front, but it's not in the numbers at the back. So there's a mismatch. So I think there's challenges there for the preparers, and I'm sure they're going to rise to the occasion.
Brilliant. That's a brilliant way to end. Thank you very much, Anne. We have just gone over that. I just want to quickly mention that we intend to have one more publication after the supplementary paper, which will be an IFRS style checklist for considering climate, which we're hoping to launch in early January to tie together the 3 papers that have been published, and hopefully will be a practical tool when preparing 2021 financial statements. So do look out for that. And just then to end and say thank you very much, Anne, Helena, Manisha, and Bolani, for your time today. I think that's been really, really helpful. And then finally, thank you very much to the audience who stayed with us just for over an hour now. Hope you have a lovely day and lovely holidays, and we'll catch you all very soon. Thank you and goodbye.
Thank you, everyone. Bye.